Hi, I'm Jason Eade Broker with Remax Finest Realty here in Kingston. Tonight we are having Cherry Chan speak at our Real Estate Investors Meetup, and she is going to talk about taxes for real estate investors. So I'm uploading the video. Be sure to check it out. If you need any real estate advice, reach out. Jason Eade, 613-561-7653. Thank you.
So thank you for having me, Jason. This is an interesting location, and I've never come to Kingston ever to do the presentation in person. So thanks for the opportunity altogether. I think I presented in the past before, and I did it for probably virtually. And I always like the in-person interaction, so then I know that you guys, when you guys have questions, and you can ask, and then I can see feedback. I like having that conversation rather than just sitting behind the computer. So this is always welcome. I don't know why this popped up, but okay, there we go. Okay, so a little bit about me. I'm a real estate accountant, like I mentioned before. I wrote this book called Complete Taxation Guide to Canadian Real Estate Investing, and that was put together in 2017, and it became one of the Amazon bestsellers for a couple of years. It is still doing really well on Amazon, and it's generating revenue. I'm surprised people actually want to read text. And I am all over social media. So if you have Instagram, where I'm on social media, and then I have a really, to me, it's a relatively successful YouTube channel sharing tax tips. So there's a lot of free resources on the YouTube side that you can watch on your own, and you will have a lot of common questions, and the answer is already there. It's not tailored to you specifically, but the general answer is up there as well. Those are the free resources available. So for today, as a thank you, I wanted to thank Jason. So I'm sharing with everybody my book for free. If you want to scan this book, you can download this book until February 15th, and you can get a copy of it.
Do we need that code, whatever you call that?
The QR code, you just scan it and then enter your name, and then the email, it will be delivered to you by email. Yes. This is just hot. Gets me. Oh. Okay. Okay. So everyone's good? Cindy is downloading my book for some reason.
Cherry, well, people are distracted right now and they're downloading that. I forgot to mention that I was going to ask if you could quickly talk about your charity also that you asked for donations to.
Oh.
And I brought a little bit of money to make a donation.
Thank you. So thank you so much for bringing that up. Usually I don't even remember about my own charity.
Okay.
So back in 2014, when my daughter was born, the year my daughter was born, my husband and I, together with a bunch of other friends, a group of 5 friends, we started an initiative. I wouldn't call it, that wasn't a charity at the time. So we basically raise funds among our clients, so they're all real estate investors, and we pull a bunch of funds together, not a lot of money, buy food for, enough for 37 families in Christmas. So we gather at one of the investors' home, put all the food together in a basket. So sort of like Tony Robbins' basket brigade. We got the idea from there, and then we put it together and then deliver to families who are in need. So we got the names from the school board, who gave us the family members families that are in need. So that we hand delivered these 37 food basket to them. Since then, we became, like a couple years later, we since become registered charity. Because I don't feel comfortable taking money and then spending it and going through my bank account. That's kind of like big no-no for accountant and tax authority. So we set up a proper charity to have donation, to receive donation. We also have since evolved from just focusing on turkey, because I recognize not everybody wants turkey, myself included, on Thanksgiving or Christmas. So then we've since evolved into ordering like jackets and boots for people who are really in need in school. So we donated, in the last Christmas, I think we donated over 500 pieces of either garments or like gloves or sweaters to local schools, also in Hamilton. And the cool thing about this initiative is that once we started, we see like other people doing similar initiative. Toronto has one, led by Jillian. I think Durham region, it's usually led by Quinton. So it's like a ripple effect, and I really appreciate it. If Jason wanted to start following suit, it would really come to help a lot of people, because we make our money in Hamilton, at least in our case, we invest in Hamilton and wanted to give back too. So that's our way of giving back. You don't even need anything formal. You could just buy 100 pairs of socks or 50 pairs of 10 pair of shoes. One year I just went to Walmart, bought 10 pair of shoes to donate to the local school, because I know that kids are wearing shoes that are broken, like open toe in the middle of winter. So then that makes a difference. It's not a lot of money, and it's every single bit helps, right?
Yeah.
So yes, enough about that charity. A little bit of disclaimer. I always love this disclaimer. I'm not responsible for anything I say here, okay? You need to consult with a professional accountant. Sometimes it may be not sometimes, a lot of the time it's relevant to you, but a lot of the time it's really, tax advice is always done on an individualized basis. It's never done on a generic basis. You need the accountant to talk to you to understand your particular situation before we can do all the tax planning. That's what it really means. Now, because right now we're at the beginning of tax season, our firm has already done 2-3 planning sessions to get gear up for tax season. So I figured, Jason also agreed, this is the best time to talk about tax deduction as real estate investor. And so I'm going to start with this. And these 2-3 slides, I'll be here forever. I could talk about that all day long. But I will try to control my time and have it I'll only talk about it for maybe half an hour. And then afterwards, I wanted to touch on some tax update, income tax update, because there are changes like there's no tomorrow over the last few years when the Trudeau government was trying to control the real estate market and stop the investment. They've put so much on us as real estate investors, so I wanted to talk a little bit about that. Not to complain about them, although in my head I'm complaining every single day, but I just thought that it would be relevant for everybody. Now, tax deduction first, the easy stuff first. In Canada, you're allowed to, basically, the Income Tax Act allows you to deduct any expenses, all expenses, reasonable amount of expenses that you incur for the purpose of earning that particular stream of income. So this is a general rule. If you think about it, if you use your car for employment purpose, drive it to visit clients, you should be eligible to claim the employment expenses, your car against your employment. Driving to your employer's office, it doesn't count as employment expenses, unfortunately, but driving to visit your client should be counted toward that. If you have a business, you have a realtor business, you have a coaching business, you have any type of businesses, any expenses that you incur for the purpose of earning the business income, within reason, you should be eligible to deduct it, subject to a bunch of exceptions, because CRA always has exception on it. But nobody is going to carry that stack of paper or the book, the Income Tax Act, everywhere, right? So that's the reason why we also need to understand the general rule. As real estate investor, you are entitled to the similar type of treatment. You're entitled to deduct the expenses that you incur for the purpose of earning your rental income, subject to a bunch of exceptions. Now, exceptions would include meals and entertainment. So if you take your realtor out for lunch, only 50% is deductible. The theory is that you cannot deduct your own meal. You can only deduct the person who you take out for business purpose meal, because your own meal is obviously not used for generating business income. You cannot take your realtor out or mortgage agent out for golf game, because apparently golf is doesn't do business. People don't do business on golf course. That's their logic. And also, if you buy your tenants wine, CRA says if you buy your tenants wine or beer, you are only allowed to deduct 50% because half of the bottle is drank by you. That's not true. I'm just saying, that's their logic. So only 50%. If you are buying a gift card to your tenant, okay, and those are the exception. If you're buying a gift card to your tenant, which happens all the time because we're a good landlord, right? Or at least I think we all are. We're a good landlord. So we will buy a gift card, and typically because our tenants need food, so we'll think or go to Walmart or like go to Loblaws and buy a gift card. And that gift card, if it is from a grocery store, is only 50% deductible because for some reason income tax act thinks that we eat the other half. So that's why when you are when you spend money, you also need to learn a little bit about the deduction because $100 gift card from Tim Hortons and $100 gift card from Loblaw, those grocery stores, you only get 50% as a deduction, okay? If you are buying $100 gift card from, say, Amazon, you get 100% deduction because it's not a grocery store. So those are the little tip that you need to learn. But beyond that, there is a general rule. So your accountant or your bookkeeper are not going to follow you everywhere, every single moment out there, right? So when you spend money on certain expenses that you think, okay, you may be eligible to deduct it, you always keep the receipt. Now, are you really going to be able to deduct it? Sometimes you do, sometimes you don't, but you compile that list and ask your accountant at the end of the year, or have the conversation, because sometimes it's borderline, maybe it is deductible, maybe it's not. Sometimes it's really clear that you're eligible to deduct the expense. Like, for example, the general deductibility rule basically saying that, hey, if you incur an expense for the purpose of earning that income, there is a cause and effect relationship, then you are eligible to deduct the expenses, subject to that exception. Now, so with a rental portfolio, rental business, you incur property tax and you earn rental income. So there's that cause and effect relationship. So you would be eligible to deduct the property tax. Property insurance, same thing. Property management, it will be the same thing, same idea. Some of them are not as obvious, like, okay, I joined a membership or a coaching program, and am I eligible to deduct it against my income taxes? Those are not as easy to, maybe to you it is, but to the auditor on the other side, if they can't see the link, like you can go to Tony Robbins' event. Everyone knows who Tony Robbins is, the motivational speaker. If you want to deduct a couple $1,000s to attend his event against your rental income, you need to be able to explain to CRA the cost of incurring the expense, how it helps you to generate the revenue. You see where I'm coming in from? Like there's no cost, like not every single expense would be straightforward, but if you think that you have a reason for it, you'll first keep the receipt, because without the receipt, there is no deduction. Credit card statement, bank statements are not sufficient for CRA unless your bank statements are shown. You're trying to deduct the bank charges, then that is the proof for bank charges. But in terms of proving that you actually incur that expense, you need the original invoice. So that includes the Home Depot tiny little receipt that you get. That includes the automobile expense, the gas receipt that you get. So those you need to keep. Are you all good? Okay.
Just have one quick question.
Sure.
So, being a real estate investor, we have a going real estate summit, multifamily conference and stuff like that. We spend thousands of dollars.
Yep.
Coaching program, thousands of dollars on that, directly contributing to your knowledge gain. So CRA looks at it that you're earning income, the better you go, mingles with the inner circles, you get better at it, your business will grow. So do they find that there's a value add link for the CRA to accept that as a legitimate expenses?
So it goes to the cause and effect relation, goes back to the same thing, right? So we have clients who spend tens of thousands of dollars on membership, tens of thousands of dollars on events. Now, we often find it hard to deduct it as accountant. The reason is because, especially in the first couple of years when you are just starting to invest, there is nothing to show. As we know, real estate is a long-term game, right? So the first year, you're trying to stabilize the property, you're barely showing anything. You will be lucky if you break even the first year because you put so much money in. And then the second year, you may make a little bit after deducting the mortgage interest and everything. And so when you deduct the coaching expenses and membership or event, you're creating a huge loss, right? If the amount is large. Some membership are way smaller, like $30, $50 a month, and it's like $600 a year. It's easy to get buried into the expenses. But if you're talking about $20,000, $30,000, CLA, and you're reporting that, and you are reporting a loss, you may be getting some money back, then you are at a risk of being audited, selected for audit. Now, if you ever get audited, they'll ask you, prove to me that you incurred the expenses. How is it related to your rent? Now, let's break it down with an example. If you already have rental, you're deducting it against your $20,000 coaching expenses against the existing rental, then how is your $20,000 expense help you manage your rental? Now, it may be really helpful. It could be, hey, because of that, I'm able to refinance. I would be able to buy more properties. Then there may be a chance. You may be able to convince the CLA agent to do that. Now, if you refinance and you're not taking any action, you just pocket the money. The CLA, then there's a less chance for the CLA auditor to be convinced because you're not taking any action and making more money. Now, some people incur the $20,000 and then do not invest for 2 years, have zero property, and they eventually take action 2 years later, and then come back to us and say, hey, like I incurred that $20,000 like 2 years ago, can I deduct it now? Well, it's harder to convince the CLA. Yes, we can deduct whatever we want, but if you ever get audited, CLA is going to come back and say, like, I don't see the link. Because it's so far apart from, like, it's that cause and effect relationship. It's not black and white, yes.
So, sometimes we spend money exploring things,
Yes.
right? That we end up not investing because we decided it wasn't fruitful. And like I just went to Tulum, for example. Went and looked at properties. It was a legitimate. We looked at properties. We considered investing. Nothing fit our KPIs. Is that a legitimate business expense?
In my eyes, if I have my way, it should be, right? Then it goes back to the nitty-gritty that you have. Like, are you going to do that trip really for pure business purpose? I always go back to the example that this Cirque du Soleil owner went to the moon. No, I'm serious, he went to the moon. It was like tens of millions of dollars to take that trip. He originally did not deduct it in Cirque du Soleil's books. And then later on decided to deduct it in Cirque du Soleil. It got buried into the expense. And CLA caught it, and CLA said, no, this is your personal expense. It's your fulfill your personal dream and publicly talk about that fulfillment. They're trying to argue that, well, because it increased the publicity for Cirque du Soleil, there's a business reason, remember that cause and effect relationship. Now, reapplying that concept to your particular case, what it means is that if you're incurring that travel expense, the trip expense, you would have arranged to see those people ahead of time. Your deduction would be limited to the flight and then maybe the hotel. Not if you are tagging on a trip along with that, then that second part of the trip you cannot deduct. So there needs to be documentation to show that, not just a receipt. You need documentation that is consistent with story to tell CLA that you will be able to deduct it. And you might also do the analysis. You said it doesn't fit your KPI. Even if it is a quick and dirty analysis, it's better than no analysis. You write down rental yield, not the 1% of your purchase price, whatever that is.
I made sure to post a picture on Facebook of us analyzing while we were there.
I saw that.
Well, but then you need to keep the documentation in case CRA comes back, okay? And it is always easier to deduct it in that your corporation than your personal name.
Right.
as against your
Yeah,
rental
for me, it
income.
would be a corporation.
Yes, so, yes.
So what is the CRA definition? How do they see expense and home improvement? So for example, in my rental,
Yeah.
I have created the flooring.
Yes.
Will it be an expense or it will be considered as a home improvement?
So if the moment that you use the word upgrade, then that is a capital improvement, so.
But it's an expense at the same time because,
mm,
so how do you project it matters that, right?
Yeah,
So
how
it's,
you,
you're replacing a worn out floor. you know?
replacing is a better term. It's like, see, choice of words matter. Like, we're only replacing it with the basic stuff. But I'm gonna get into it as well.
Okay.
So, okay, going back here, I'm sorry, we got sidetracked. So going back to the most common tax deductions, finance charge. Right now, a lot of real estate investors are borrowing against using private money to finance their purchase. So finance charge includes the mortgage fees or mortgage agent's fee or lender fees that you would be eligible to deduct against your rental income. And these charges are deductible over 5 years. Now, these finance charge also includes, like, for example, CMHC insurance. If you purchase a property with less than 20% down, you are required by law to purchase that mortgage insurance. And if you purchase that mortgage insurance, it's being added onto your mortgage. You don't pay it until like over the next 25 years, essentially. But that amount, that $20,000, $30,000, is deductible over the next 5 years. So you actually get to deduct the expense. It's important to keep the documentation. These type of documentation, if it is for CMHC insurance, it will be in your closing document. And there's a separate piece of paper that shows the actual amount of CMHC insurance. Do you want to ask a question?
No.
Okay. Yes.
I had a question about the last point, about the trip. The CRA, would CRA potentially typically accept arguments that you do this regularly? So if you went on 4 trips and on 1 trip you bought a property, then they might go,
Yeah.
oh,
Not
your trips,
really. Yeah, absolutely. Everything matters. How you construct your whole story and how you argue, that matters. Yes. But it has to be shown with business purpose.
Yeah.
Yes. Line of credit interest, I don't know how you guys started, but majority of my clients, myself included, I started by borrowing against my primary residence and then use the fund to purchase my first investment property, and the interest incurred on the line of credit would be tax deductible. Now, a lot of us would have the line of credit, the HELOC set up. We're also using the HELOC for multiple purposes. So also on our personal stuff, just keep in mind that only your the portion that's related to your investment would be tax deductible. Now, the sad part is once you mix the two, the personal use and the business use of your line of credit, then even your payment is being mixed, repayment. So let's say you now got a $10,000 bonus from your employer, and then now you want to pay down your line of credit. But your repayment, that $10,000 to pay it off, is now proportionally assigned to both the business use and then also the non-business use. So then your your line of credit interest would always be proportionally deducted. Will never be reverted back to just the business portion. I don't know if that makes sense.
does that affect your personal income? Because if you've taken that 10,000 and you're forced to split it,
Yeah.
is part of that now count as your,
No, not income. It's just repayment of the loan.
okay?
Yeah. So make sure you also keep your line of credit statement. Usually you get a line of credit statement around this time of the year that shows how much interest you pay for the full year. Sometimes the line of credit get merged into a mortgage with your home mortgage, because it happens all the time. The portion that's related to your investment would still be deductible. So let's say before you have a $500,000 mortgage and a $100,000 line of credit that's purely used for the purpose of investment. Now at the refinancing, the bank requires you to roll the entire thing into one big lump sum mortgage. Then 1/6 in total, because 500 is the personal mortgage, the 100,000 is the business use line of credit. That balance, 1/6 of the interest would still be deductible. So you just need to be able to keep the documentation on how you use the fund initially, and it just get merged into one lump sum, and then you prorate your future mortgage interest for deduction.
So CRA accepts a
Yeah.
each time you change it, the prorate, you memorize that number and you move
Yes.
forward to
Yes.
the next
Yes.
significance.
But you need to be able to show the original documentation and then continue to keep the documentation for the row and then the second row or the third row as well. That is the paperwork that you would need to get to keep, okay? Mortgage interest, obviously, if you borrow money against your personal, you borrow money to buy that property, it is tax deductible. Now, what mortgage interest doesn't, what people don't know is that if you move into a property and then you then decided to rent it out and buy your next dream home, the mortgage interest on your I would say if you borrow against your the first home to buy your second home, the mortgage interest on that would not be tax deductible because it's not for the purpose of earning rental income. So you've got to be careful with that. We talk about property tax. You need to keep annual property tax statement. Utilities, typically you can get annual bills directly. You can download them directly at the end of the year. You only need to do it once a year. So it's relatively simple, straightforward. Insurance policy, typically they're tax deductible, and make sure that you keep the annual insurance policy. Property management fees are tax deductible, but I found that majority of the property management companies don't send the invoice. Sometimes they do, sometimes they don't. So make sure that you ask for the invoice if you don't have it. If you have a statement that shows you the rent that they collected on behalf of you, the property tax, the property management fees, and only the net amount get deposited in your bank account. Make sure that you account for the property management fees and the rental income collected separately, because we need to show the full amount. CRA actually look at your lease agreement when they audit you. So if the amount don't match, they automatically add that number to your top line. Okay. Accounting fees, bookkeeping fees for doing your personal tax return are not tax deductible, but the accounting fees and bookkeeping fees for doing your schedule of statement of rental income is tax deductible. So it's important to make sure that it is worded accordingly. So we talk about repairs and maintenance and upgrade versus replacement. Repairs and maintenance, they are essentially you're replacing, you are incurring the expenses to restore your property to the original condition, to keep it going. So repairs and maintenance would typically involve like paint job. Painting is usually repairs and maintenance. If you have a water leak, the cost of the repair would be considered repair and maintenance. Now, why do we have to get into this? Because sometimes we do, as mentioned earlier in the room, a lot of you have legal secondary suite. I don't know the going rate of renovation here, but in where I live, the going rate could be $100,000 to $200,000 range to convert a legal basement suite. Now, that $100,000, is it considered repair? In my eyes, in everybody's eyes, it's repairs. But in CRA's eyes, they're not repairs. They're called capital improvement. So you have to capitalize it. When you capitalize it, not that you're not getting the deduction. You're just not getting the deduction until you sell the property, which could be 5 years, 10 years down the road. But the money is out the door today. You're only getting that deduction 5 to 10 years when you sell the property. But versus if an expense is being identified as repairs, then you get 100% deduction today against your rental income. If it is a loss, then it could be going up against your employment income. It could trigger a refund. That's why as a taxpayer, you always your bias is to call something repairs and maintenance. And CRA's bias is to call everything capital expenditure. Now, also, when you call something capital expenditure, if it is a long-term investment, when you sell it, remember, you incur capital gain. Capital gain in Canada is only 50% taxable. So, in another word, anything being used to reduce that capital gain is only 50% deductible. So, if something is called capitalized item, It's really meaning that that expense is only 50% deductible. Versus if something is called repairs and maintenance, it's 100% dollar for dollar tax deductible. I see that I'm losing some people here, so I,
No, you're not.
yeah.
Oh,
No, that's
terrific tax information.
Great explanation.
Now, okay, good. So repairs and maintenance, there are exceptions, like painting, replacing the light bulbs that they are normally considered repair and maintenance. CRA put a bunch of exceptions there. They love to make things a little bit more complicated to make our life interesting, right? So what they do is they say if you're spending the money immediately after you purchase the property, any expenses that you incur for the purpose of getting that place ready for rent is considered capitalized expense. So if you are spending the money to get the place ready to for sale, that portion of the expense is also considered capitalized item.
Which means you can't write it off, is what you're saying? Or
You can, it's just being
Yes.
less, yes.
50%.
Yes.
Yeah.
Now,
Sorry, do you mean like if you paint before you sell? That's a capital?
yes, for the purpose of selling, yes.
You mind if I just ask you something else that was that was probably me, or like I thought I was all confused, but you said something about oh my gosh, I'm losing it. Because everybody turned around and looked.
It's okay,
No.
hold that question.
Okay.
Let me finish the repairs and maintenance and then we can,
I'll
if
come
it is not related to repairs and maintenance, yeah, hold that. So, now, that painting is a good example. Now, I think somebody, maybe it's in my head, but somebody was asking flooring. So if you replace the flooring in between your tenancy, not immediately after you purchase the property, that $10,000 on flooring replacement is 100% deductible. Now, I'm saying replacing it, okay? If you're replacing basic laminate with basic laminate, then that is called replacing. Now, if you are replacing laminate with hardwood floor, that's called upgrade. Okay, there's a difference, okay? Upgrade is capitalized. Replacing with basic stuff is called replacement, so then you can write it off. Now, roof is always a good example. I like using roof. You buy a property, if it has to, you have to replace the roof, you don't have a choice, otherwise it's going to cause water damage, then you replace it immediately. If not, wait a little bit. You have a choice. If it's, yes, you know that it has to be replaced within the next couple of years. Wait until you rent it out for a few months before you replace it. Now all of a sudden it's not getting ready for rent, then you can write it off.
So it's only the first time you're getting it ready for rent?
Getting ready for rent is also considered
Capitalized.
capital item.
But if somebody moves in, they stay there for 2 years,
Yeah.
and then if they leave, and you're like, oh, I gotta upgrade, I gotta bring it back to normal?
Yes.
But did you say you could use the wording to change that capital and get the full 100% write-off, or just by?
No, not my wording.
No,
The wording matters
It's
and
the
you
way
have
you
the auditor. Yes.
So you can't use like that word that guy said about replacement or something, the fella here, he said something
Yes.
about- So you said you watch the way you word yourself with it.
Yes.
So you still can basically get around that only
Yes.
50%
Yes.
rebate and get the full 100.
Hopefully,
Yeah.
replacing. You have to show some evidence.
And since I'm on that now, I just wanted to ask you that question.
Yeah.
You said something about the IRA or the CRA checking you out for if you get money back 1 year and you're paying them all the time. Well, I got money back 1 year and then now I'm paying them a lot more. But did you say that was a reason for them to come and look you over? or
No,
something?
years of, multiple years of
Oh.
rental losses would be one reason for audit.
What about bad tenants?
Yeah, that could be it too, like
Years
that,
of it.
yes, absolutely,
Mhm.
but then you'll also really truly be exposed. But if you have bad tenants, you have nothing to hide, everything is
Mhm.
legitimate. You should be reporting a loss, and even if they ask you to open up your books, you should be happy, like, hey, this is,
Yeah, receipts.
I really have. Speaking of bad tenant, it's a good example to lead into my next discussion. If you do have bad tenants, they're not paying, it's important to keep the documentation that you communicate with them that they're not paying. You like whether it is those one of the N11, N12 or whatever form that we're talking
N12.
about. Yes. And it's important to keep those forms. I know it is hard to believe, but CRA, when they audit you, they look at your lease and they see that, hey, you said that the lease said that you should have 12 months, but you only reported 10 months because you truly did not receive those 2 months, right? CRA would just say, no, you received the 12 months, unless you can actually show the evidence that you have that communication of the filing. So it's also important not just to keep the receipts. Receipts is one thing. I think I have it here. Bad debt. The receipts is one thing to prove your expense, but if you didn't have that rent, make sure that you also have communication proving that. Yeah.
Is there a specific time period that they look at for when you first purchase property before you kind of get out of that capital improvement stage and into the replacement stage?
No, it's a lot of it is really your it's really how you report your taxes and if there is reason to audit you. They do focus audit these days because their ROI, because the ROA also look at ROI. Their return on investment on targeted audit is a lot higher than just doing random audit. So they really look into doing those targeted audit. One of the area is the employment expenses. I don't know if anyone deduct employment expenses. If you do, those would be the area of focus as well. Selling properties is also an area because some of them could be considered capital gain versus flipping income as well. So, okay, we talk about. I'll just hold that questions until later. We talk about repairs and maintenance that are not considered that are not considered capitalized expense. We talk about it has to be replacing it or restoring it to the original condition. Upgrading would not work. Upgrading your kitchen to like brand new granite countertop, those don't work if it has wood before. Now, if you have to do it, you don't have a choice, then do it. And that expense is still available for deduction. It's lesser deduction, smaller deduction, it is still available. And it is deducted as something called capital cost allowance. Now, you can deduct the wear and tear of your property over the duration of ownership against your rental income, assuming that you have net rental income. But this capital cost allowance, they are similar to RSP. So the year that you claim it, you get a tax deferral. RSP, it's a tax deferral. The year you sell the property, all the years of capital cost allowance that you've deducted, you have to take it back into income, just kind of like RSP withdrawal. So this deduction is a tax deferral mechanism. I don't like it. I don't like it either.
No, I don't. Not at all.
It is what it is. Now, but sometimes it may be worthwhile to claim the capital cost allowance, especially for those of you who have like large net rental income and you are not planning to move into the property. So this would be helpful. But again, this is a deferral. It's not a deduction. It's an option.
Why don't you like it?
Huh?
Why don't you like it? You said you don't like it.
Oh, I don't like the complication of it. In the past, this is considered a tax shelter thing.
Right.
So years ago, you can take capital cost allowance to create a big loss to offset against your employment income. And then they restricted that. So now real estate is no longer a tax shelter. In the past, real estate itself is considered a tax shelter. That's years and years ago when I first started, I guess, before I even started my career.
So it was a gain before, and now you better pay it back eventually.
Oh, it was always paid back, but then the doctors and dentists who bought into these big properties, they can get the write-off. Now, it was unlimited write-off. Now it is limited by the net rental income that you're reporting. Okay.
Sorry, by net, do you mean across a group of properties?
Yes. It's pulled together as a calculation. So if you own condo fees are tax deductible. You need to at least have your condo fees noticed as approved. Bank charges, if you have a dedicated bank account, the bank charges is tax deductible. We talk about membership fees and events as well. We talk about how important it is to take action to convince CRA for a deduction. And then auto mileage, if you drive your car for the purpose of managing your properties, you would be eligible to deduct that expense. But it's only up to the amount that you incur for the purpose of running your rental portfolio as well. So the way it's being calculated, you take your total gas receipt, take all of your automobile expenses and prorate it based on the mileage that you've incurred for the purpose of running around for your rental portfolio. So if you drive 1,000 kilometers for the year to manage your rental portfolio, and then for the full year, for everything else in total, the car's been driven for 20,000 kilometers, 5% of all the expenses would be tax deductible. But you also need to keep all these backup receipts and everything. If you want to know more, my YouTube channel has an automobile, how to deduct your automobile expenses there, so you can check that out on all the detail on how to deduct it. Home office expense, similarly, if you don't have any other location to manage your portfolio, your home is the only place, you would be eligible to deduct your home office to manage your portfolio. And again, only that portion of your home office of expenses will be tax deductible. So if you have a townhouse that is 1,000 square feet, and one of the bedroom is used as your office to manage your portfolio, that's 100 square feet, then 10% of your utilities, mortgage, interest, property tax, condo fees, insurance would be tax deductible against your portfolio. But you gotta be careful. Sometimes this may tip you over and may make your primary residence considered non-primary residence. So sometimes it's that 5% or 10% that would tip that over, and you may not want to deduct it because you could have your home as the main floor, and then your basement's rented already. So then 40% of your property is rented out. In order to preserve your primary residence exemption, it has to be primarily used as your residence. So you have to be able to show that. And if you're deducting home office expense and you're deducting you're renting out the basement, then it may tip you over to the other side. Then maybe it's not worthwhile to claim home office expense. Okay. Other documents that you should also keep are your lease agreement, your purchase closing document, your sale closing document. Some of the expenses that we talk about, the capitalized expense that you incur for the purpose of like renovating your property, getting it ready for sale, those expenses, those receipts, they are considered capitalized item. The capitalized item is only deductible when you sell the property. So you need to keep those receipts 7 years after you sell the property. All right.
Whoa.
So it's only for the cost that's associated with capitalized item.
So put a
Please
new
don't
floor
tip the
in.
table for that, yes.
So you put a new floor in today, and you sell the house in 12 years, you have to keep the receipts for 19 years.
If it is considered capitalized item, yes. That's just because you're not claiming that deduction until at that point in time, and then they have 7 years to go back. So, does that make sense? Okay. Yes.
I have a question about, just because you were talking about home office and capitalized stuff. I'm building a 700 square foot office in my backyard. It was already built. I have this big detached garage that was converted. It has its own separate hydrometer. It has baseboard heat.
Yeah.
But I'm like gutting it and re-insulating and brand new everything, and it's gonna probably cost about $40,000 to $50,000. Is any of that can I write any of that off as a cost of my office, or is it all going to be like capital against the property when I sell it? It's not a rental property, it's my house. There's no rental with it.
It is a capitalized item in
Okay.
that particular case, because you're getting the whole thing and putting pretty much everything in there.
Yeah, I'm doing everything over.
Yeah, so it would be tough to consider that as,
Because it has wall paneling and insulation, but it's the old pink insulation and it's half fallen out, and the wall paneling's old, and I just want it
you're
nice.
telling me too much information.
Oh.
I would say that it would just be repairing it, that maybe there's a better chance.
There's the wording again.
So could I repair half of it and do the other half, like the capital improvement on the
It goes back to
heating
your
system?
invoice.
Okay,
What
alright.
it says on the invoice itself too, right? If you have invoice and pictures, those are important.
I definitely have.
But if he's
pictures.
using that for business too, is that not a business write-off? I mean, can we not?
I get where you're coming in from. It's a bit confusing
So we gotta
because,
stick to the R word.
yeah.
Yeah.
Okay.
Yeah, it is because it's also primary residence that he's doing. You have to define the relationship, you can structure it a little bit differently. Your business will pay you personally to rent that space, but then how much are you paying yourself? And then it gets really complicated. Then you can claim a portion of that expenses, but then it gets complicated. I don't know if you really want to get into that as well.
Yeah, probably not.
Yeah.
Okay, thank you.
So, if you have corporation, make sure that you keep the articles of incorporation. I mean, you don't really have a choice, the bank always asks for it. Bylaw, director resolutions, those are really important documents. If you are, I think you mentioned that you're a joint venture person, so joint venture agreement is very important. Make sure that you keep a copy of the joint venture agreement forever, until 7 years after you sell the property. Trust agreement as well. If you have a trust setup, if you buy properties in your personal name, you buy it in trust for a corporation. If you are the money partner in a joint venture relationship, you are the one on title, but someone else actually co-own the property with you. By a joint venture agreement, there is also that trust relationship, and you will need to keep a trust agreement as well on top of the joint venture agreement. Okay, so how do you keep all these information in an organized format? Typically, my client would use a paper-based storage system. That's one option. Option one, you just have one envelope for annual expenses, and then one envelope for a permanent folder. I call it permanent folder. Those are the folder that you need to keep it for 7 years until after you sell the property. Those are for that reason. So this is how majority of the people would do it. A lot of us are collecting receipts and then taking pictures these days, and you can use an online storage system. Any Dropbox, anything would work. This is mine. I use something called ShareFile. So in my internal folder, I would have per property, the same system as you would otherwise with paper format. I just store them directly in my directory, internal directory. So I can always collect that information, access that information as well. And then sometimes people use a combination of both. So now I'm done with the deduction. If there are deductions that you didn't see and you think you should have seen it, make sure that it is always covered under the general deductibility rule. If you have a question about, for example, gift card deductions, then feel free to visit my YouTube channel. One of my earlier YouTube video is about gift cards and what's deductible and what's not deductible. Now let's talk about income tax changes as real estate investors for 2024. Marginal tax rate has always been adjusted. I don't know how familiar you are with marginal tax rate. In Canada, personal tax, you're taxed on a progressive tax system. And what it really means is that the more money you make, the more tax you get paid. So if you look on screen here, between $0 to the first $12,000 in 2023, you pay $0 tax. Between that $12,000 and $15,000, that delta of about $3,200, you pay 5% tax. That's 5% tax charged by the Ontario government. Now between $15,000 and the $49,000, the delta between the two, which is the $34,000, that $34,000 is taxed at 20%. It's a combination of federal and Ontario taxes. So if for someone who makes $100,000, we basically go back to the tax bracket multiplied by the corresponding marginal tax rate, combined between federal and Ontario, and we add them all up. And for someone who made $100,000 in 2023, that person would need to pay about $22,000 of tax. For someone who make the same money that person who make $100,000 in 2024, that person would only pay $21,658 because these tax bracket is being adjusted on an annual basis based on inflation. Now, so this could be really eye-opening for some people, some of you, because anyone who makes over $246,000, anything above and beyond that, CIA gets to keep more than you get to keep. So if you make $246,000, $247,000, and then the boss tells you, hey, like you get a $10,000 bonus, that $10,000 bonus is going to be subject to 53% tax, meaning that CIA get to keep $5,353, and you get to keep less than their share.
Very kind of them.
So that's what this really means. Now, this also means that, hey, if you are flipping houses, now this is not the market to flip house, but it could very well be the market to flip house. At least if you get in now, and then maybe in a few months you will be flipping it for a profit. If you happen to be in that situation and you sell a house within 12 months, that would be considered a flip. Now, if it is a flip, 100% of that income is taxable. 100% of that profit would then be added to your, like, let's say this person that's making $100,000 is happen to flip a house and make $50,000. That $50,000 is dollar for dollar taxable. So on top of the $100,000, now this person is reporting $150,000. So that additional $50,000 will have to go through tax rate like 34%, 37%, all the way to 43%. So just because you make $50,000 from the flip, it doesn't mean that you're going to be taxed at lower rate. You're still going to be, there are more tax rate on top of your employment income.
What if he does it in corporation, not in his personal life?
Yeah, if he does it in the incorporation, the corporation will only subject to 12.2% tax, only on the flipping income.
And they can do that multiple times still?
Yeah, so the first $500,000 net income in the corporation generally is taxed at 12.2%. Generally, like there are some exceptions as well. So now that's only for flipping. If you're buying for capital gain, the tax rate is different. Okay. Okay. Now, the biggest thing in 2024, in my opinion, is this trust reporting. Yes.
Sorry, you just made an important point about long-term versus flipping. So if I was doing flipping, I should probably have a separate corp for doing flips versus buy and holds.
Yes. So the reason why you want to have a two corporation and not mixing the two is because CLA we talked about capital cost allowance earlier, right? So you understand the concept of capital cost allowance. CLA would not allow you to claim capital cost allowance if you mix the two together. That's their rule. If you have it separated, then flips are flips. Flips, no matter what, you're not allowed to take capital cost allowance on to defer revenue, but rental you are allowed on it. But if you mix all your assets together, they won't allow that. And sometimes it also matters with also bank loan. Although when you do flips, then you typically you're using short-term money. But for your long-term investment, the bank likes to see your holding company only do rental investment income. They don't like to mix the active business income, which is flipping income, with your long-term rental income. When they see that, they pull out from the deal. And I don't know, they don't like you to make money. It's just so weird. I have a holding company myself, and we were so close in getting one of our student rentals to refinance. And then they saw this $10,000 income because it was one of our earlier corporation that we set up. They saw like a $10,000 consulting fee in there, or a $5,000 consulting fee on the schedule, and they're like, well, no, you have active business income, we're not lending it to you. This was obviously a real story.
So much to learn.
So if you are earning active business income, for mortgage purpose, you should really put it on in another corporation. Don't mix the two. Yeah, sometimes we advise our client not just based on tax, but on practicality and then mortgage qualification as well.
But if the corporation is new, they would definitely ask for personal guarantee, and then they would need your income to qualify that, and how do you dodge that part?
Great question. It depends on, my experience is that they always ask for personal guarantee.
Right.
Regardless, whether it's new or old or whatever, they always ask for personal guarantee, so you'll never be able to get out of it. Now, depending on the type of mortgages that you are qualifying for, sometimes they use your income to qualify. So student rental, you would be eligible to use that student rental income to qualify. The problem is that our our property value is so high, the rental income was never enough to qualify on its own. Or we as investors are so spoiled with this 80% financing thing that we wanted to maximize the mortgage. And the only way to make the mortgage work and to qualify is to use part of your income for it. Typically, if you use the rental income of the property to qualify for financing, you may be able to get 50%, 60% loan to value with the mortgage. And we, as a group of Ontario investors, we want way more because we want to leverage. So that's where the difference is. But if you go to like say Meridian, because I used to work with Meridian on my mortgage, they would be eligible. They would tell you that, well, your property the number would only work if you put like 40% down. But it will qualify you purely based on the rental income. So some people
Meridian will do that?
it's commercial mortgage, right? Meridian, Desjardins, a bunch of the commercial mortgage guys will do that. Now, the qualifying rate is now really high as well, so then it will also bring the mortgage amount
But
lower.
when the rates drop down, then
A portion of our clients who do not have full-time job, they would not be able to qualify for anything. But they were able to pull money out from their property using Meridian's, like not just Meridian, many banks would have that. It's just, some banks do prefer to see the personal income, but Meridian, they do have a program that do not. And most credit unions would have those type of programs. They have more flexibility.
hello, Meridian.
Okay, so trust reporting. Trust reporting is a big thing in my world right now for this year. It's effective as of January 1st, 2023. Basically, a lot of real estate investors would purchase properties in their personal name, qualify for financing, but then they want to take advantage of owning the properties in the corporation, the flexibility of owning the properties in the corporation. So the legal title is still belong to their personal name, and then but the income, expenses, assets, and liabilities are all reported in the corporation's name. They can do that because the Ontario law, Canadian law, actually all the Western law recognize the concept of something called trust concept, recognize this thing called beneficial ownership. They allow this relationship allow you to separate who's on the legal title and who is the true beneficial owner. So these two can be separated by law. Now to do that, to allow you to separate the two, you typically need to sign something called a trust agreement between you and the corporation, and then the corporation then would report all income and expenses. Now, this whole concept also was abused by, apparently, according to the government, a lot of, essentially a lot of foreign investors. They would get a local person to buy the property and claim that person moving in, but they never really move in, and then the person would use their primary residence exemption and then sell it. So that relationship also get abused. This is also a common arrangement for big real estate organization or a land developer to come together and use to buy a property together, and that's how it usually works. And it's commonly used in the real estate world, not just in residential real estate investors world, but it's also to essentially the whole real estate investment market. Now, CRA wants to know who the true owner is. So, because if they go on land registry, they won't know who the true owner is, because that's only showing the legal ownership. But the true owner could be someone else. So now they want to crack this relationship down, and therefore they are now requiring people who are in this type of relationship to report to the government. If you were in a relationship like that, you need to file a return by March 31st of this year. Now, so if you ever have a trust agreement signed, that is one of them. If you have a joint venture agreement, and the joint venture agreement basically says that you co-own the properties together. Basically, whoever reports it is different from whoever that owns it on title. then there is a trust relationship, and then now you have to report this new return, file this new return. Now, this does not only apply for real estate, but it also applies for a situation where, like, for example, my mom put me on her property title because she is not always in Canada. So I help her to manage her property. And so she put my name on title because then we need to call these, like, City of Toronto out, we need to call the utilities company out, and I don't own the property. I'm not entitled to the rental income. I'm on it because I need to help my mom to manage the property. And there is a lot of situation that next generation essentially just got added to the property for managing the property's purpose, to make their family member a little bit easier. And those are also trust relationships. There is no proper trust agreement documenting it, but it is a trust relationship. Now this also applies when your name is being added to your parents' bank account to help them manage their banking affairs. So sometimes our name is being added to our parents at bank account and they have over $50,000 cash or $50,000 of publicly traded stock. That's also a trust relationship. And all these require you to file a T3 return by March 31st, 2024. So I don't know if that makes sense. I know it doesn't make sense. A lot of our government stuff don't make sense, but that's how it works, yes.
So do both people have to file it, or just the person on title has to file that there's somebody else in trust?
Yes, the person that's the trustee has to file.
Yeah.
Okay. Now, so you can end this type of relationship as long as you decide to make sure that your legal title and your beneficial, whoever that reports the income and expenses and assets and liabilities, they're equal to each other, then you would be able to end that filing obligation, but not until the year after. For the year that you end that relationship, you still need to file by the following year, and then the year after that, you would be able to get exempted.
And is this on your YouTube channel? Because this is just like making my head melt.
Yes,
Okay.
yeah. Yes, it is on my YouTube channel. It's okay, it's late. I get it. If you don't file, there is a penalty, of course. It's way more, but this year there is no filing penalty because they recognize that majority of us would not know what to do, would not even know that we have a filing obligation. So there is no penalty on late filing. But if they prove that you intentionally do not file, then they can charge you as much as 5% of fair market value of property. So you're raising, if you don't file, then you're kind of raising with against them in terms of catching you not filing. So you may as well just file at some point, right? If you want to avoid a 5% penalty. Okay. Yes. So the penalty is waived. That's what I meant. Now there is also HST on new purpose-built rental buildings. I know a lot of you are in this game of converting properties into fourplex. Unfortunately, conversion do not count. So this wouldn't apply at the moment, but it may be applicable in the future. But if you're converting the entire commercial building, if it is commercial building and you're converting it into 4 units and above, this counts. But if you're converting residential single-family home to 4 units, it doesn't count. But if you're tearing the whole thing down and then rebuilding 4 units, then this counts. Now it gets a little complicated. But what counts? You may wonder. Well, the reality is that in the past, and even now, what happened is that when you build a new build purpose-built rental building or do conversion, when you are doing it or doing substantial renovation to convert a place into a rental, you're required to pay CRA HST at the time when you complete it if you do substantial renovation. I know you don't agree with it, I know. 13% on fair market value you would have to pay at the time when you complete it, complete the rental. And then you can claim some rental rebate, and then you are still out of pocket for like $80,000 in my example. And you spend like $700,000 and the property is worth 1.5, and after claiming everything, you still are out of pocket for $80,000 for creating rental supply in the market. This is, yes, a little bit ridiculous, but that is how it is. So, so it added an extra $80,000 that you need to pay. And now CRA came out, basically the province of Ontario as well as federal government also came out, announced that if you, anything that you start building from September 14th, 2023 onwards, if you're building 4 units and out, and 90% of your units are for long-term rental, Airbnb short-term rental don't count, then essentially you don't have to pay HST at all. It could create a delta, in my little example, a delta of $171,000 because you get all HST back. But this is only restricted for any property that you started building after September 14th of last year. It can only be started after that day. Number 2 is that it has to be 4 units and up, and it's only commercial to residential conversion count and new build count. Tear down counts, but converting an existing residential to residential don't count. I don't know why, but.
Are you hearing anything in the trade, the government is considering expanding that to the residential case?
The bank, the legislation hasn't really officially come out, and I've been calling them, and they so far hasn't been really. Yes, they are still like this draft legislation has been circulated among the GST HST department, but no final words have come out yet. So we have quite a few clients that are converting mixed-use properties to all fully residential. Right now, we're not even clear if that's going to qualify. Because typically, the mixed use is the bottom floor is commercial, and then top floor is residential, right?
Yeah.
So unless your commercial unit is converted to 4 unit, then a portion of your bill would be qualified.
Right.
But then the residential side doesn't. So yes, it's very confusing, but it's one step to the right direction. Under Used Housing Tax Act, this is one of the most confusing thing ever. Thankfully, it's all gone for 2023. But if you haven't filed for 2022, you would still need to file. You have until April 30th of 2024 to do the filing. Basically, anytime you own any residential properties inside a corporation, you will have to 3 units and under. You will need to file this form. You don't file it, it costs a huge amount of penalty. But in 2023 fall economic statement, they've since recognized that this is a lot of work for real estate investors, so they decided to cancel this pretty much for a lot of the affected owner, but only for 2023 year and onwards. So for 2022, if you own a property in a corporation, chances are you may have this filing obligation. So that's that. I think I basically did everything that I prepared.
Perfect.
Oh, 834, so good.
Great.
Yes.
Thank you.
So you talked about the receipts for the organization. Do you recommend any software that we can use as an accounting that can help us, organize things apart from the computer-based system and the paper one?
Yeah, so I myself use a system called HubDoc, and a lot of our clients use a system called Dext. Now, it does require setup, and it does require diligent upload constantly. So unless you have a bookkeeper that knows those type of software that work with you, sometimes it's really hard for us to explain how it would help you organize your life, because a lot of us, the truth is, we have a lot of corporations or a lot of different entities or business, and you will need multiple of those accounts. The reality is that if you use like software like QuickBooks Online, they have the same function, that you could use it to take pictures and upload it as well. So it requires certain analysis before you implement something like that.
Just to add on to that, so since you're dealing with multiple real estate investors, so how should be the communication between an accountant and the real estate investors so that we both are on the same page and we're actually getting things done rather than exaggerating or getting it disorganized? So how should be the mode of communication with the accountant?
Typically with our firm, we have an onboarding call when a client sign up. We walk them through some of the best practices, and we also walk them through all the questions that they have in our initial onboarding call. Now, we are also an accounting firm that we can only be with you for a period of time. So the dedication and the training and the discipline, it still has to be with you. Now, we always tell our client the simplest way, if you're starting out, one account, one bank account, dedicated bank account for one property. Easy to track. At the end of the year, we only look at that activities as well as the dedicated credit card. If you have a corporation, then you can have that corporation, everything disciplined. Helps you to put all the rent in there, all the expenses related to the corporation-owned properties would go through that particular bank account, so it's easier to do bank transactions. Now, in terms of receipts, it's really, it's a hassle and it's really hard, and I constantly battle against that myself because we have multiple businesses, multiple corporations to own the properties as well. It is, again, diligent and just recognize that it is really hard, and recognize that you're operating a business and you do have to be diligent. And what we found the most challenging part, I'm sure Cindy can attest to it, is people typically would wait until last minute to get things done. These things has to be clear on a regular basis. If it is not weekly, as a minimum, monthly, on a regular basis, to cross-check. If you can do that, then your year-end process will be so much easier. But if you're only thinking, oh, I don't want to deal with it, not to Jason, but we have a lot of realtor clients, they just don't want to deal with it, and we're not magicians. We can only do things based on what you've given to us. So it's also very important to be diligent and understand that you are really operating a business and there's a cost associated with keeping your books clean as well. So, yeah.
My experience in the professionals is that I often go in and they expect me to guide the conversation, and I'm kind of like, yeah, but I'm not really a real estate lawyer or real estate accountant, so I don't actually know what's that important. If I came to you or your colleague or whoever in your firm, like Mike, how do I get you guys to ask the right questions to get me telling you the right information? I guess that's,
It's always a little bit of an art and a little bit of challenge as well. The more we build a relationship with you, the more you talk to us,
right,
the easier it is. We even have to, it is embarrassing, but every single year we ask our clients if they are still married and if they have kids, or if they are planning to have kids. Like, okay, come on, if you are self-employed, if you want to claim EI, we need to know that you have this plan, and then we need to start contributing to EI and telling you that. But 1 year we put that in our questionnaire. 1 year we started putting it in the questionnaire to help us plan more. We have a standard list of questions that we ask our clients to help to guide that conversation. It's also important that you come out to tell us, hey, like I have this plan to do this, convert this hotel into like residential property. Come to us when you're planning and thinking about building it, doing it. Those conversations is way more valuable than after the fact that, hey, I did this.
So do you have that's like I have, I don't know, 4 corporations,
Yeah.
3 joint ventures, and a half dozen properties or something. It's like, I don't know where to start when I talk to you. So do you have like if I said, okay, can we have 2 hours to review my situation as part of a planning process? Is that an appropriate use of the time as far as you guys are concerned?
Yeah, absolutely, yes. We do, Although 2 hours is a very long time.
Whatever, whatever.
But typically, we have that conversation within 1 hour, but we do have those conversations. Cindy is having those conversations day in and day out, and along with another team member as well. Yeah, yeah. Yes,
Can I ask a corporate structure question?
sure.
So if we've got a holdco and then a corp that's, has buy and holds and then an active corp.
Yeah.
But now I'm looking to expand into the bigger multi-space that usually requires a corp to hold the bigger multi, that I'd be partnered with somebody who's like, is my holdco gonna be the partner on this corp, or do I need to open another corp to be partners in that corp for purchasing multis?
I think from a tax perspective, they're all taxed the same way, okay? Now but then you have to look at multiple angle. Tax is only one cost, but then there's filing costs as well. So you have to look at the cost angle. And then there is why you want to have a holdco, a brand new holdco, to hold your equity in this new multi-holdco. Typically, people have a holdco about this because they want to be able to shelter some of the money in there. And the benefit of that is that you will have, if any dividend is being distributed to your holdco, then you do not need to personally report it, and you have flexibility in terms of planning. If this is important to you, then you'll set up having a holdco. Can your current corporation structure to own shares of your new multi-unit holdco? Yes, it can do that. But then if the money goes up there and you ever get sued, then that is the risk that you're exposing yourself to. Now, maybe you'll never get sued, and chances are you'll never get sued. But some people place a huge priority on that. Then that is the question that you need to be able to answer yourself. Like, if you don't care, like, you don't think you're ever going to get sued, then yeah, like, it's all fine. Use your existing holdco. But then it's not a question for me per se.
Right.
It is a personal preference. So that's why it's all.
Tax-wise, there's no implication.
Yes. But there's a cost associated with setting up a corporation, doing the filing, and all of that. Yep. Mm-hmm. Okay, last question, okay? Before you, yeah. Oh.
No, go ahead. With someone else?
No,
No,
go.
going back to the new build.
Yes.
So I'm building 2 houses, just residential, one family, let's say, to rent.
Yes.
Will I have to pay that?
HST, yes. Yes. If it is rental, you will have to pay the HST. Yes. Yeah. It's single family, yes. You can claim $24,000 back. You have to pay it. I mean, during the same process, you net against the $24,000 and all that. You do all that together. You have to. I know this sucks, and they try to encourage us to build like rental housing. It's not helping at all.
And what does it do after it's done, after you start deploying rent? Like, what is?
Typically, is when it's ready for rent, or when it's first rented. Typically. Now, depending on your ownership, I'm assuming you have a corporation that owns it, and I typically would say that it would be likely at that time when it's ready for occupancy, or like when the year-end tax filing is.
And it's based on value of the house, was it? The HST?
It's fair market value of it.
Fair market.
But then you subtract whatever you pay as well, whatever HST that you pay.
Right.
So it costs you money to build, right? Like there's material and the cost of the build. It's a net that you remit to CRA and subtract the HST rebate. If you ever need help, we're here to help. Yeah. Okay?
Thanks for coming.
Hey, thank you. The most smiling host I've ever seen, watching me the whole time smiling, because tax is not fun, right? So,
No.
you gotta smile.
I've developed a new mindset though, and I hate doing accounting. I hate paperwork, but I want to be successful more than I hate that stuff. And it takes the same amount of effort to do a shitty job or to do a good job same amount of effort to do it late as to do it on time, so you might as well just nip it in the bud and get it done.
Yeah,
I'd say
great,
it's more
great
effort than it
attitude.
should be.
Yeah.
I wish all my clients are like this.
Yeah. Okay, I have a little money for your charity, so thanks for coming. Anyone else that they want to give any?
You are giving me money,
I'll give you money for your mittens
thank you.
for children.
Yes, yes,
Appreciate your
yes,
help.
yes, thank you.
Thank you so much.
We'll send you the receipt.
Okay.
Yes, thank you.
Nice to meet
We
you.
appreciate it, yeah.
Thank you so much.
Sure.